I mean, Japan has not really crashed and they've been doing their thing for 30 years. So maybe it's the new norm. Maybe this modern magical money theory will actually work out and you can just print money and trillions of dollars and nothing, and we can keep rates low and low and lower and they just keep going. Maybe we'll have negative rates, probably will. Maybe not nominal, but real. I mean, if you can have 1% trades, but if it's ultimately what I'm getting at is that we're in a space of who the hell knows what's going to happen. But we're not dealing with fundamentals anymore. We're dealing with euphoria and hysteria. We're dealing with a lot of scared money trying to find some place for yield. Where what's it's crazy. Gold used to be this thing where people would say, "I don't want gold. I like gold personally. I like gold a lot." They didn't want to do gold because they said, "Look, it's a zero paying asset. Like if you have gold, doesn't pay you anything. Well, neither does cash." So if you're just going to have something, you might as well have gold. At least you can't print gold. And so the rules are all changing. I mean, you have to start thinking, how am I going to get anything? I mean, the savers are getting screwed. The baby boomers, the people that are saving money, working hard, saving, they're getting toasted. Why? Because the elites and the bankers are trying to make sure their friends get richer and richer. The divide that we've got between the haves and the have-nots is getting worse because the haves are getting more, and then basically people are becoming more enslaved and needy with the government, and they're getting scraps. Like it's crazy what's going on. I'm concerned that this euphoria, people are just going to get eaten alive, not only by the stupid mistakes, but because they're giving up their freedom. They're saying, "Oh, government, take from me. Oh, government, you can save me." And the government's not going to save you. It's going to take your freedom. Power grows and power begets power. And ultimately, power begets that there's an absolute power that happens. You see this now with things like in China, you've got a centralized digital currency, the digital yuan that's being rolled out. This is going to be used for things like social scoring. They're already doing it with facial recognition. Everything you do is monitored. And if your money is monitored in a centralized system where it's not, maybe the government knows. It used to be, at least in America, and I don't know how long this has actually been not the case, but for a long time, things were private. Well, now it's like everybody's talking to everybody. Google talks to the U.S. government. The banks are talking. There's all these. You can't tell somebody if the government's looking at your stuff, and there's no warrants. It's kind of just a free for all. But the more that this goes on, ultimately you end up with a centralized currency. And to my concern, I mean, you can make money, create that all, but the problem is you start losing freedom. And if you lose freedom, then what's the point? And I think people are ignoring that because they're so busy, or they're so scared, or they're so in fear. And so they're not really looking at what's going on. What's going on is our freedoms are being eroded. And that's my biggest concern. And the next biggest concern is that people are losing if you look at the Weimar Republic in Germany back in the early 20th century, people go, yeah, that was like a hyperinflationary environment. And hyperinflation happened in year 4. It was 50 plus billion%. That means gone. Like your purchasing power is toast. People stole your wheelbarrow and left a pile of cash. That's the old story outside, when you had that thing. But what happened the previous 3 years? And this is really relevant to what's going on today. The previous 3 years before the hyperinflation, you had really bad inflation. And really bad means you lost 96% of the purchasing power of the Deutschmarks. So those 3 years, nobody was saying hyperinflation. They were saying, oh, I can buy less. What is happening right now in America? In 2020, lumber went up 114%. That is what it looked like in the Weimar Republic. It was that type of stuff. Corn, soy, silver, gold, all these things got more expensive. They're still the same thing. It's still a freaking ear of corn. But what happened is that it takes more dollars. So over a 3-year period, are we going to lose 96% of our purchasing power? It's looking pretty bad. We're going to lose 15 to 20% this year, guaranteed. And people are oblivious to this. So you've got to make sure you hedge with different thinking, with different ideas, different investments. Having money in the stock market when it's at this bubble insanity, or having it in cash, you're in deep crap. So you got to start thinking differently. And people are so tired and they're freaked out about the pandemic and everything. They don't realize it's happening.
What I expect is, and I'll make a prediction. Currently, multifamily cap rates in the U.S. are at 5.1%. That's Class A, B, C together is at 5.1. And we've held to that number now for almost a year. Now, it's obviously been dropping. It used to be 8% at the height of the 2008 financial crisis. And since then, it's been dropping. It's a very kind of smooth curve decline as interest rates have gone down. My prediction is that you are going to see that number drop below 5. And I think that my prediction is in a year, maybe a year and a half, we end up at about 4.8 cap. So that 0.3 cap differential is a very substantial increase in prices, and it has nothing to do with rents, right? You know, in the next year and a half, if rents don't increase by $1, you're still going to have a very large increase in prices because of that cap compression that we've been seeing all along. So my prediction is that a whole bunch of syndicators that bought stuff in the last 3 or 4 years and overpaid, well, you just caught a break. I think that all of you guys are going to be, if you can hold on and not mess up your properties, I think that you're going to have a great cap rate exit. You may not hit your goals on rehabs. You may not hit your goals on rent bumps, but I think that it may not matter. If you get 2/3 of the way there, your cap compression will take you the rest of the way there. So I think this is a phenomenal time to continue to buy, but be very cautious because like every other market, that is bullish. This is a very bullish market. There's a great level of aggression right now in the marketplace. A lot of people want to buy. People have been on the sidelines for 9 months, assuming the worst, and it didn't happen. And really nothing bad's happened. I mean, if you compare today's multifamily market with 12 months ago, what's the difference, right? It looks the same. So to me, I think that you are going to see a increase in competition, a very significant increase in competition. But that is not a reason to stay out of the marketplace because the Fed's given us another 5 years of a glorious multifamily market. We just have to be careful not to overpay, right? And me on my side, I'm very thrilled with where I am because I pivoted to becoming a developer and building my own multifamilies 3 or 4 years ago. And now they're coming to market. I built Coyote Creek. That one's about 2.5 years old. It's now leasing up. And I'm leasing my one bedrooms $130 higher than my pro forma. Can you imagine what happens if you go $130 higher? My 2 bedrooms are about 75 above pro forma. My 3 bedrooms are $80 above pro forma. So in about 4 months, I'm going to refinance and give my investors 100% of their money back and then hold it for 10 years because it's in a very, very fast growing market in terms of rent increases. St. George has seen about a 2.5% rent increase during the pandemic. So same sort of story for, Mesa. I mean, we have a property in Mesa. Mesa's seeing very terrific rent increases. So we've used demographics to follow these markets around the U.S. and say, right now it doesn't pay to be a buyer, so I'm going to be a seller. And of course, that takes 3 years to, gather the money and go through the zoning and the entitlement, the surveys and the environmentals and then basically build a sucker and then lease it up. And then wait 3 months and then either refinance the heck out of it or sell it. So I'm absolutely thrilled with where we are.
And that's my ultimate prediction here. What are the fundamentals anymore? And that's why I'm thinking that we will ultimately have a pullback. Yes, there could be inflation. Yes, there could be flight to quality, tangible asset, all the things I already mentioned. Agreed. But the properties don't make money anymore. Are we good with just not making money in real estate anymore? I mean, okay, great. I love this. Let's buy real estate with no real fundamentals by valuing the property on cash flow. Let's do that. Perfect. Every deal's a good deal. Then don't worry about cash flow anymore. So every deal's a good deal now. Let's just go buy real estate. Hallelujah, man. That makes my job awful easy. If we can just go buy stuff and it's 2% cash flow and we're good with that, I love it. I think that's absolutely absurd. Mm-hmm. But I think that's kind of what we're looking at in the market right now is people are buying properties with only on pro forma, only on projection. And basically, I teach and I've worked with you guys and I've worked with a lot of students, a lot of people that are new to the business. And what I'm seeing right now is a lot of people are basically analyzing a deal and they're more or less saying, hey, this deal sucks. But that's okay because I'll raise the rent. And as soon as I raise the rent, the deal won't suck anymore. I think that is a complete departure of fundamentals of real estate. You're saying this is junk. These numbers flat don't work. But I'm going to go ahead and reward the seller because there's nothing else to buy, because everybody else is doing it, because this is the market. And we all have to get up and go to work each day. And that's why I kind of made that comment that humans just keep doing the same thing over and over until they're stopped forcibly somehow, which is why markets always cycle up and down. You're just going to keep doing the same thing until you can't. And that's what I'm saying. That's what I'm seeing. The fundamentals are leaving the market. When you're buying properties at, cap rates that match the interest rate, There's not even any spread there, you know, and so you're overpaying for these properties just because you believe that you're going to be able to raise the rent. Well, I'm telling you, going into a recession cycle, that is an extremely risky business model. And that's one area that I think we're going to see a big pullback is when a lot of the syndicators, a lot of people in the world out there realize what's happened. They've overpaid. They were planning on getting giant rent increases. They're not. By the way, there's 20% of the tenants not even paying the rent, let alone you're going to increase rent on them. And then they're going to say, okay, well, this didn't work. We'll just go ahead and sell the property. Oh, by the way, you got a 10-year Fannie Mae note. That's $1 million defeasance. They didn't tell you that. And now you're trying to sell the property. Now it's a loan assumption. And we're seeing this problem. It's like half the deals out there, you've got to assume the mortgage. People don't like loan assumptions. You got the wrong debt. You're trying to exit early. You got bad debt service ratio. All of these things are pulling the pricing away from good old-fashioned fundamentals. And that's why I'm predicting, regardless of anything the politics do, the stock market, or anything else, we're going to see an ultimate decline because real estate just doesn't really make much money at these prices. And it's turned into a giant mattress that people are just going to stick money under. And that makes, as a syndicator, sure, if none of my people want to see cash flow anymore, hallelujah. It makes my job awful easy. I don't think that's going to be the case. And that's why I really think that all of the asset classes will have a price decline. When, I'm not exactly sure. I'm predicting within another year or so, you're going to start to see it. And that will move us into another market cycle, which is why I wrote the book and why I brought out information that's going to be very applicable for the upcoming market cycle.
So number one, why is this a thing? It came because the federal government wanted effectively to incent private capital to come into what were considered poverty rate areas to effectively gentrify them. You know, think of like spots that haven't had any capital infusion in 50 years. They've just kind of gone by the wayside, but they're still in metroplexes and areas with a large enough population. And say, hey, let's get the capital in these and let's incent private capital to come in and try to do this. And the way we're going to incent it is through the tax code, through some tax deferral, both on the capital gains that they invest in and the capital gains that they get out of the real estate opportunity. That's basically how it came about. So, I mean, if you looked at the various census tracts in the United States, I think you're looking at like 8,000 different census tracts that qualify. So it was pretty broadly sweeping across the area. So this could be anywhere in the U.S. Like if you look at the map of the segments that qualify, it's all over the place. And that's actually what makes it complicated. It's not one place. It's just whatever census tract in whatever area, whether it's rural or urban, that qualifies in every state. And for your investors and part of your equity that you invest, you have to hold that 10 years to have no capital gains tax at the sale, in year 10. So if you sold it in year 5, you'd get like 10%, maybe 7.5% off your capital gains. But in fact, if you hold it for the whole 10 years, you don't have any capital gains tax burden. Say you put in $1 million and at the end of 10 years, it's worth 3. You're not paying anything on that $2 million a gain, but it's for the long term. And this is the right structure. I'm very pleased to see this actually being structured because it helps people. You got to be committed to this. So both on the front end with development of the municipality, but also you're not incented to pull out or undercapitalize the asset because you got to hold this thing for 10 years and it's got to perform for 10 years for you. So you're committed to that. You're committed to the community, and that's exactly what they want. The reason you invest in these properties is because you get 2 things. One, you get deferral of your initial capital gains. So in my case, I get to defer the short-term capital gains on my crypto sale until December 31st, 2026. So instead of paying, in 2022 tax season, I get to pay by December 31, 2026 on whatever the short-term capital gains rate at that time is. So I'm buying myself a good amount of time. And then number 2, on the actual property, you get to defer that capital gain. So if that property appreciates $2 million and you theoretically have a $2 million cap gains on that, if you hold it for over 10 years, you don't have to pay anything. You just take the cash and go home with a smile on your face. So those are the 2 tax bits I'm talking about. So if you refinance early, you don't get to defer the short-term bit. I think it's due basically when that refi happens. But if it's over 2 years, you can still defer it to December 31st, 2026. So again, This is why I said it took me some time to find somebody that really knew this, because when you call somebody and ask, you can tell because they will tell you all the nuances. They'll be like, but if you need to hear but like 5 times because that's how all the laws are written. But if this, that, that's how you know somebody's qualified.